Holy cannoli, as my girlfriend would say, the Russell 2000 down over 5%. The NASDAQ down almost 4%. We are exactly 2 hours into the trading day. A lot of people are questioning and even talking about a possible volatility halt. If one of the indexes falls 7%, well, the stock market will get halted for about 15 minutes. Now, I don't know if that is going to happen. It definitely looks like we're on that trajectory. We have not seen a volatility halt since the crash of 2020, and they are quite exciting, but it's definitely showing you something when you are that close to potentially seeing a volatility halt. When the Russell 2000 is down 5%, you got to ask yourself, what in the hell is happening in the stock market? Because we didn't get any crazy news. There's no real reason you could point to this besides what we're going to talk about here in this video. It's very obvious what is going on, but at first glance, it's hard to tell, right? There's no breaking news headline for the day, nothing that would have forecasted the Russell 2000 to be down 5% and the VIX to be up 21.37%. The VIX is actually starting to break out now, showing a little bit more fear here in the market. So let's talk about what in the world is going on, or holy cannoli, like my girlfriend would say, in the stock market. So we're going to get into all of that. We're going to talk about AMC stock as well, because we are seeing some interesting things going on. So hit the like button, subscribe to the channel, source those comments, questions, or concerns down below in the comment section. Thank you guys for tuning in. If you guys want to come trade with me live in real time, we have been making a lot of very profitable moves over the last couple of trading days. You guys definitely want to be a part of it if you are interested in growing your knowledge around trading and learning how to profit from these events. It's been pretty nice for the overall portfolios, and the option trades starting to balance out some of the stock losses. So nonetheless, let's get into this situation. So the biggest thing that you could boil this down to, if you just wanted to throw, a reason at why the markets are falling, it is because that inflation report we got on Friday. Nobody expected inflation to be that high and to be that widespread. So essentially what the markets have been expecting, and why the markets actually bounced up a decent little bit, if we look at the S&P 500 going from 380 back all the way up to 417 at the high, and we also profited off of this rally. It's because the markets were expecting the Fed to slow down or potentially stop raising rates in September. Well, now that we got that inflation reading on Friday, it's basically saying that the Fed has no choice but continue to raise rates even, through September, through November, through December, possibly even during a recession. And that's what the markets are really freaking out about today. It's not what we expected to get, the inflation report, and now the Fed will not be able to stop raising rates in September. So it kicks the can down the road, for lack of a better word, of when the Fed can potentially U-turn. And if we look at the Fed rate monitor tool, which this is a great tool for you guys to use, and it kind of projects out where the federal funds rate is likely to be by these specific dates, and these are all Fed meeting days where they do raise rates. We could see December 14th, the probability of higher rates is going up even more. You have 38% of market participants believe by December 14th, the federal funds rate will be in between 3.25 to 3.5%. And you also have about 32% of market participants that expect rates to be in between 3.5 to 3.75%. And even 8.4% of market participants expect the federal funds rate to be in between 3.75% and 4%. The higher you get here, it's basically saying, hey, you're looking at a 1% rate hike, or you're looking at 75 basis point rate hikes, and essentially the Fed not slowing down. And then you even go out to May 3rd, 2023, most market participants expect the federal funds rate to be almost 4%. And these are, yes, historically low rates overall. You guys can see the federal funds rate typically has been a lot higher throughout history, right? But the markets are not used to having a high federal funds rate. Like people, if you were investing in the 80s, the 90s, then you look at a 4% federal funds rate, and that's half of what it used to be in the 80s. But it's still a lot higher than what we have seen since the great financial crisis during 2008. So you're definitely getting a lot of fear from that. And you do have like a lot of zombie companies that have to raise debt, and there could potentially be a lot of bankruptcies. Around 12% of S&P 500 companies are considered zombie companies that cannot meet their debt obligations and cannot service debt with free cash flow. So that's obviously the reason why the markets are selling off today. We'll see where it goes by the end of the day, but you also are seeing this. And I think this is really affecting a lot. It says expectations for inflation and spending hit record levels in May, New York Fed survey shows. And this came out today at 11 in the morning, so about half an hour ago. It says consumer expectations for inflation and spending both hit record levels in May, the New York Fed reported Monday. Expectations for the stock market also hit a new record low, and job insecurity levels rose despite otherwise robust hiring. It says the outlook for price gains in the coming year increased to 6.6% for the month, up 0.3 percentage points from April, and tied with March for the highest rate on record for a survey that goes back to June 2013. That came even though three-year inflation expectations remained essentially unchanged at 3.9%. At the same time, median household expectations for spending increased over the next 12 months, soared to 9%, up a full percentage point from the previous month. That's up sharply from 5.5% rate to start the year and nearly double the 5% expectation from a year ago. So yes, people are spending more, but the next year inflation expectations are up to 6.6%, which is obviously not good. And why is that not good? Well, the Fed says their most important job is to keep these inflation expectations anchored, because essentially what has happened and why you are seeing inflation right now, it's not just because of the war in Ukraine. It's not just because the China lockdowns. It's not just because you gave people a bunch of stimulus. What it actually is a lot of business owners, and I know business owners personally that did this, so I can speak from personal experience here. They essentially heard that inflation was going to go crazy, that prices were going to go up over the past 2 years because of all the stimulus money. So what did they start to do? If you owned a restaurant, right, you raised prices months and months ago, and you might be raising price again because the actual cost of your product is going up. So when you have high inflation expectations, these businesses start to raise prices because, hey, if people expect high inflation, then if you raise prices, customers don't look at you like, wow, you're raising prices on me, right? Nobody likes to get their price raised on them. But if everything is going up, if people expect it, then it's not as big of a deal. And that's why inflation expectations are so important. And that's why that's the Fed's number one priority, to keep those inflation expectations down. Now, breaking news right now, European stocks closed down 2.4%. Bond yield spike as traders fret over a possible recession. Now, I will say, when you are going into a recession, or when there is, fears about inflation, that's when you see bonds doing what they're doing like today. The bond yields are going nuts. The 10-year treasury is at 3.32%, up 0.17% on the day. That's a wild move. I think TLT is down over 3%. So there's obviously a lot of people that are selling bonds, but when you do get fear of a recession, and what comes with a recession is deflation, then you'll see the 10-year treasury go down, interest rates will chill out a little bit, and that will be good. But it's really this tug of war between, when are we going into recession, and how much does the Fed have to actually raise rates once we do go into a recession? Because a recession's one thing, the Fed raising rates is another thing. But if you get a recession and the Fed raising rates at the same time, that's a bad situation. And that's, I think, what the markets are very fearful of at this current moment, or at least they will start to get very fearful on that. Just give it a little bit of time. And as you guys do know, for the major catalyst this week, you do have PPI month over month. That's 7:30 in the morning tomorrow. Core PPI month over month. Couple bond auctions, inflation rates for other countries. Nothing too important besides that. The OPEC monthly report, that could be important for oil. But on Wednesday, that's where you get retail sales month over month. And then you do also get the Fed raising rates with the FOMC economic projections. You get the dot plot, you get the expectations for raising rates. And we'll see if there's any new changes to policy, or if the Fed says anything new. And then at 1:30, well, it's actually 2:30 Eastern Standard Time. I think this is 1:30 p.m. Central Time. then you will get the Fed that speaks. And remember what happened last time off of the initial report that comes out at 2 p.m. The markets dropped about 1%, and then Fed Jerome Powell came out, and we ended up closing 3% positive on the S&P. And we made that in about an hour and a half's time. So it's going to be very, very volatile tomorrow and on Wednesday, and I would expect to see a little bit more downside here, especially since we're breaking, down into a very key level. I mean, you're under 380. This is the lowest you've been in 2022, and it's happened in a very short amount of time. Depending on what the Fed says it can be very bearish, but it could also spark a bullish reaction, especially if we do have another deep red day tomorrow. I think that could be potentially the low, and then you could probably bounce off of the Fed. Obviously, I'm not a fortune teller, and it's going to depend on what the Fed says, but you have seen a lot of carnage in just 3 days' time. The S&P officially hit bear market territory, so we are down over 20%, and definitely has a lot of people fearful, and you can see that reflected in the VIX, up about 20%. Also, it's not helping that crypto is completely destroyed over this weekend. It went all bad for crypto in a very short amount of time. This says Bitcoin dropped 17%, falling below 23,000 as 200 billion wiped off crypto market over the weekend, and the total value of crypto now fell to under $1 trillion. Bitcoin used to single-handedly be close to $1 trillion by itself. So that is really what is going on in the markets. Markets are going to be fearful heading into the Fed. Question is, do we get a relief rally after the Fed, or does the Fed say something that really jives with the markets the wrong way? And I think anything is possible there, but the more pain, potentially the better to see a reversal after the Fed. So we're definitely seeing a lot of pain today. Now, for AMC stock, the max pain is $16 per share by the end of this week. It was sitting at $18 per share by the end of this week, so it has come down about $2. Now, what we're seeing for AMC stock today, 22.48% short interest of free float, almost 116 million shares that are sold short today. But look at this, the cost to borrow minimum, cost to borrow average, and cost to borrow max are going up, especially the cost to borrow minimum and the cost to borrow average. Cost to borrow minimum is sitting at about 14%, cost to borrow average is 19.72%, cost to borrow max 25.55%. So the cost to borrow max is not changing all too much. It's actually went down about 0.5%, but the cost to borrow average and the cost to borrow max are going up, and I think that's more important because it's saying, hey, you can't even lend out stock, you can't get shares to sell short for less than 14%. So that's very, very sizable, and that makes a big difference in the duration and the time frame on how long these shorts can hold on to their positions. So I think that's very interesting, and I do think that is a very, very bullish thing. Now, we do have 100% share utilization. Not a big surprise. It's been like that for months now. The days to cover sitting at 3.66, shares out on loan 190.32 million. Free flow out on loan still sitting at almost 37%. So there is a lot of shares that are out on loan that could potentially be used against us at some point into the future. Now, for the day, we're looking at 0% positive order value. Forget anything else. It's 0% positive order value. So that's obviously not a bullish thing. We'll just call it that. A lot of shares are being sold short currently by the market makers due to all of this negative option activity. And that's very important to point out, that these market maker shorts can be very fluid. So on a daily basis, if you see a lot of puts coming through that are close to the money, well, you can get a lot of shares that are sold short. Let's say the next day you have a big rip. Well, the market makers, they go out and rebuy that stock because now they don't have to deliver stock to the put buyers. Hopefully that makes some sense. It acts just like short-term short interest, right? Pushes stocks down on bad days, a lot of put activity. Well, it can dramatically push stocks up as well when that directional move does start to go to the upside. So very, very exciting right there for eventually what is going to happen, right? If the short interest is really 22.5%, let's say the Ortex numbers are correct, well, you could add at least 20 25-50% more to that short interest just due to the market maker shorts that they have on currently. Now, as far as the option activity, if you guys have not seen the video talking about a gamma squeeze from last night, go ahead and watch that. But you do have about 3,600 calls that are in the money, 351,000 calls that are out of the money, and 134,000 puts that are currently in the money, with about 79,000 puts that are out of the money. So both of these numbers, in the money puts, out of the money calls, those are the most important things, and that controls about 50 million shares total. If even half of the calls went into the money or half of the puts went out of the money, that's going to be about 25 million shares that the market makers might have to buy, potentially in this week by this Friday. If that were to happen, that's about a whole day's worth of volume, or roughly close to a whole day's worth of volume, and that would push the stock up in a very dramatic way. But obviously, I'm not a fortune teller. It's going to depend on overall market conditions. It's going to depend on what the Fed says, so on and so forth. But I do think we're in a pretty good situation right now, right? The more AMC falls, the less risky it is to add to those positions. Now, in the grand scope of things, keep this in mind. Don't forget this. We have not done anything between, May 24th, May 25th, when we were sitting at about $10 per share and rocketed all the way up to 16. We've been in this range. Yes, we are starting to trend down today, down almost 9%, but we're still at $11.36 per share. So in the grand scope of things, we're definitely holding up very well comparatively to some other stocks. Look at Coinbase, down 14% today. Look at Square, down over 10%. Like there's a lot of other stocks that are down much more, and I do think it is still possible to see a pretty big rally by the end of this week. All things are said and done, as long as the Fed does not talk about a recession too much, or just doesn't freak the markets out. If the Fed freaks the markets out, then there's gonna be nothing that AMC could specifically do. Now, we did get the Dominion numbers, where Dominion for the box office over the weekend was about 143 million. So that was very, very bullish. And then you also seen Top Gun Maverick, which did score about $50 million at the box office. That did not have any reaction, any bullish reaction whatsoever for AMC stock today. So I think that could be a little bit of a delayed effect. We actually did rip off the open and then just sold straight off. So it wouldn't surprise me to see a little bit of bullishness head into AMC stock if the Fed does not surprise the markets. And I keep reverting back to the Fed because that's the single biggest, most important thing for the markets as of right now. It's going to dictate how hard a recession is going to be ultimately. So that's that. Like I said, we really have not done anything on a technical basis. You want to watch the 50 and 100-day moving averages in between about $16.35 per share and about $14.97 per share. These key levels, if we can break out above that with some bullish momentum, it'll be really good. Again, not a fortune teller, so I don't know exactly what is going to happen. The MACD is curling down, almost going bearish, and the RSI is getting to extremely oversold levels. The neutral level is 50. We're currently sitting at 41.11. So that is going to be all for this video. That is what you guys need to know. Hit the like button, subscribe to the channel, source those comments, questions, or concerns down below in the comment section. Thank you guys for tuning in. Get your free stock with Webull, Moomoo, and Public down below in the description. And like I said, if you guys want to come trade with me live in real time, link down below in the pinned comment. Thank you for watching, and I will see you in the next one.